Welcome back to the Everything Property Podcast. Now, the topic that has been on everyone's lips is buying property in trusts. You hear it absolutely everywhere. Your neighbour over the back fence has got his opinion and everyone at the family barbecue. But do you actually need to buy property in a trusts? What are trusts and how does it all work? Or who better than to bring on than a person that has been working in the accounting industry since before I was even born, with over 40 years of experience, and you've possibly seen his face across social media before. But Chris Charlton, welcome to the Everything Property Podcast. How are you?
Yeah, thanks for having me. I'm excited to be here.
Yeah, mate, pumped to get you on. And we've seen a lot of your content. If not, I'll link it in the show notes. But Charlton's Accountants. You've been a wealth of knowledge in that sort of short form video space, and I thought we'd get you on to talk about buying property in trusts and maybe some other accounting advice or knowledge that you've learned over the years. But look, before we get into that, tell me a little bit about Chris Charlton and 40 years of experience. Where has that sort of been in the accounting industry? Where did you sort of start? You know, where have you sort of ended up, and where's the business at now?
Cool. Yeah, well, as you said, I've been had my own practice for over 40 years. Started when I was 14. 16. No.
Yeah.
No, really, it's I worked for a couple of bigger firms to start with and worked out that I really like doing tax type work and reading material and nutting out ideas. And I sort of found myself going overseas. I was actually had offered a job on the Isle of Man. I was going to do some tax planning over there. It was pretty cool.
Yeah.
Watch the motorcycle races. And my wife couldn't get a job, so we came back. And then I thought, well, I'll start my own practice. So I think it was about 26. And the biggest problem I had when I started was I looked too young, which is pretty weird these days. So I grew a beard.
Hey, you're having the same issue now. Come on.
Yeah, I know. And that sort of worked out well. And that's back in the day, there wasn't any internet, no computers, no social media, no advertising. You were restricted. Accountants couldn't advertise. And the best you could get away with was putting a sign up outside your door as long as the letters weren't too big. And I thought, gee, this is hard. So my first office, I built a little office in North Sydney, and I had a little reception area. It was all blocked off, my office in the back, and I'd come in every morning, and there's a typewriter. Nobody knows about typewriters.
Oh my God!
Take the top off the typewriter, spread some papers out and whatever, and put there's a flower in a vase, the whole box and dice. And my landlord was on the same floor, and he used to walk past my office like probably 10 times a day. After about 6 months, he said, "I've never met your secretary." And that's because I didn't have one. It was just the sort of the start off there. And, over time, I had to get clients. And how to get clients? Well, you can't really advertise, so it's word of mouth. And I found myself having to go and do talks. So I put myself out there to do a talk, and know whether it was a Rotary meeting or a ladies' lunch or something. So I had props, and you couldn't actually, there's no screens. You had to go up with you had a big easel with a huge writing pad on it.
Jesus.
And I'd have it all out in black text, and my writing shit out, so it took a long time to read it. And then I'd have props, and I'd have lots of things there. So that was fun. And from that, I got clients. So I developed a bit of a patter, but people today want to know things about how you do stuff. And that was great. And I had my grounding. I worked for a firm in the eastern suburbs, which are very, very strong on tax. And I have fond memories of that. So I learned a lot of the things you need to know from that, good grounding. And they were pretty hard, like you couldn't make mistakes. They used to say, ask a question once, that's okay. Ask it the second time, probably haven't explained it. Ask for a third time, kick you in the arse, and ask the fourth time you're fired. So I never got past 2, thank goodness. From there I sort of, North City, moved offices, grew bigger, got staff, various buildings, etc. But there's always a focus on tax, small business, individuals. And I like the one-on-one stuff. I mean, you talk to mum and dad, or you talk to the guy who was the tradie, or the guy that's was starting up his own business, and they all wanted the same advice. And nothing much has changed, I don't think, in all that time. People still want the same type of advice. They want the right structures. They want to be able to, pay the bills. Most of the people I met are all very honest, very hard-working people, and you respect that. So when you're putting together a plan for them, you're seeing they've got an outcome. They want to pretty much bring up a family, or they want to actually, work ethically and properly, and they're talking about product cycles and all sorts of things. So, I've seen every type of business you can think of over that time, and most of the clients that I got in the early days, I've still got some of them. I give them ranks. You're client number one, and I think I had client number one for years, and he retired, and I said to the guys that were number two, guess what? And they said, what? And I said, client number one.
Wow.
We got promoted. It's fantastic. So you evolve a bit, but you keep clients long term, and you just talk to them, and you keep it, simple. be very patient, and you teach them compassion, how to be compassionate about their business and how to be empathetic with people. And as long as people get the vibe going, you can actually do wonders for them. But the key is really simplicity, I think, and patience, listening and doing. And most people just need some guidance. I was saying before that pretty much I reckon everybody I spoke to that no matter what stage of life or career, 80% of what you know you already do know.
Yep.
You don't know that, so I've got to tell you that to start with. And secondly, we just work on the 20%. So we focus on the positives, not the negatives. I won't tell you what you can't do. I tell you what you can do. And we work out options. And most people say, I've got option 1, 2 and 3. And I say, what about 4, 5 and 6? And you go through them all. So you might end up back at option 2.
Yep.
But at least they know what you've sort of rejected in your thought processes, and they get good at it. You train them to do that. So career-wise, I've been in my current location now for about 8 years, I think it is. Been in the city for a while, but it's pretty much haven't changed any of the moving parts. It's got lots of people, and there's about 16 of us plus me.
Yep.
And we still got the same vibe. You're still looking at the little guy. Now, we were clients that are in the late teens, and we got clients that are in their 90s, and
wow,
and we get generations now. That's pretty fun too. You get mum and dad you had for years, and your son and daughter or whatever, and then all of a sudden they've got their kids coming through. So most of my staff tend to be younger. So we've got our sweet spot is probably that late 30s to probably mid 40s, and they're the people who really have done the hard yards, got a business going, got their career going, and they really started to make some money and they want some extra advice. So whatever stage you're at, we sort of got people there. But the bulk of our clients will be that sort of area. Yeah, it's been good.
It's I can only imagine the amount of sort of lessons and what you've learned over the years. And I think what you were saying before is the issue with definitely accounting and properties, that a lot of people don't know all their options. And as you said, there's an 80%. Sometimes it's a little bit lower, but there's a base of knowledge that people have, and then there's the extra knowledge on top that the expert brings in. And I think setting yourself up with an accountant with an accountant is one of your core team members for majority of our audience is, property investors or people that are interested in buying property, whether it's first home buyers or people that haven't invested or people that have 5, 10, 20, 40 properties. So accountant, one of those key guys that you definitely need on your team. And I think one of the things that comes up often with property investors is this idea of trusts. What can you tell me, or how can you break that down to a fundamental level to explain that to the everyday Joe that hears it on podcasts and hears it on all these professional property investors that have these multi-million-dollar portfolios? How can we break down and explain actually what a trust is and how it operates?
Yeah, okay. Well, there's sort of two things that are pretty constant there. That over the years, one, I love real estate, love property. I've always had involvement. I've invested in myself, even developed property.
Yep.
So I know a bit about it and all the nuances of it. The other thing I like is trusts. However, people use them usually wrongly. Most trusts I've seen set up by others have disasters. So it's almost you just go and buy one because, somebody said go and buy a trust, but you don't know what to do with it.
Yeah.
And I've taught people out of buying trusts and said, well, let's talk about the types of trust. And they say, well, is there more than one? Because most people think the trust is like a discretionary trust. It's the family trust.
Yeah.
And that's pretty good. And you go online and there's a couple of dozen people that sell you one of those.
Yep.
And so they go and buy one online because it's cheaper that way.
Oh.
Yeah. Oh, so many people buy stuff online.
Oh. Yeah. Buying trust online.
Buying trust online. And I must say, most of the ones you buy online are actually well put together. So they're not duds, but they don't know what they are and they don't know what they're used for. So, again, without being complicated, keeping it simple, like discretionary trusts are great because, as the name suggests, that any income that comes to that trust, you have the discretion normally to distribute amongst family members. And then you have another type of trust, like a unit trust, a fixed trust, and they're a little bit different again. They tend to be more relevant for groups of people. So I look at those more for property developers or, a couple of guys getting together, pooling their funds and wanting to buy some property. Unit trusts are pretty good because it's got that fixed, proportion, which is really good. And that also, too, you can say, well, if partner A puts in 40% and partner B puts in 20% and so on, they can issue the number of units in terms of proportion. So it keeps it pretty fair, etc. Another type of thing that is a trust is a super fund. That is actually a form of a trust.
Okay.
Now, beyond those sort of three main areas, people get very excited about things called hybrid trusts and all sorts of trusts. No, don't worry about those. I mean, keeping it simple. So if you've got big bucks and you've got a big company development, whatever, you can have all these different types of trusts, which are just, as the name suggests, hybrids of all these other ones as well. So the thing that confronts people the most is just, I want to set up a trust. They're normally talking a family trust. And in most cases, that's the thing they're talking about. But the componentry of setting it up is that you need to have a trustee. Okay, and most people know that. The biggest mistake I find is people are told, or they put themselves in as trustees rather than a company.
Mm-hmm.
It's a little bit of a, it's sort of like, technically speaking, can a couple of people be trustees of their own trust? Yes, you can, but it's just not best practice.
Why is that?
Well, it tends to intermingle the money. Okay. So you say, well, am I buying this property in my name, myself and my wife's name, for example, or am I buying it myself and my wife's name as trustee for the family trust? And as long as it's really clear, you find that the banks and finance companies and brokers, they get it all wrong, and you get things all over the shop. So, if something goes wrong, if you just say you've got a whole bunch of property in your trust that's you and your partner are trustees for, one of those partners dies. They try to get things changed around and fixed up, and it's just a mess. Particularly with shares, it's a nightmare. Mm-hmm. So I say to people, look, don't be a tight ass, spend the bucks, get a corporate trustee. Mm-hmm. That means you've got some protection there for anything that happens maybe in insolvency.
What's a corporate trustee? Just for
PTY LTD.
Okay, so setting up a company is then the trust.
Yeah, well,
the trustee
of the trust. Yeah, and I find that's just pretty much normally what people do. They go to an accountant, you decide to do a trust, corporate trustee. You're the directors, you're the shareholders as trustee for the trust. The other thing in trust is the beneficiaries. Okay, now the beneficiaries are normally, in a family sense, you if you're an individual person, or you and your partner. Mm-hmm. They're the primary beneficiaries. And then the secondary beneficiaries might be the kids, etc., etc. We used to list those in a trust years ago. We don't anymore, because if you list the children in a trust as beneficiaries, then the bank wants ID checks on all the kids. Oh. They're trying to take a 2-year-old in to actually sign up for the bank, so a bit of a challenge. So they're in there. They're definitely there. And then you have, in most trustees, you find a clause that says beneficiaries can include, brothers and various family members. Mm-hmm. But also a very important clause that most people don't look at and don't know is there is a clause that generally says that a beneficiary can include any company or trust that the primary beneficiaries have an interest in. So that sets up a whole bunch of new beneficiaries, like other trusts and other companies, which becomes very important in tax planning. Okay. And if you want me to give some insight there, which is one of the biggest mistakes I find, is you've got a business. They might own some real estate. They might have a business running through it, and the company corporate trustee, and then the only beneficiaries are mum and dad. So they have a really big year that year. So in a trust, you must distribute the money out to mum and dad. Mm-hmm. If you don't, you get hit with a really penalty rate of tax. Okay, so mum and dad says, right, well, we've earned $400,000 here, and it goes on top of their salaries. They've got a horrific tax bill. Mm-hmm. And you go, well, why don't you have a corporate beneficiary? What's that? So we have a PTY LTD company, which also becomes a beneficiary. Right, so to distribute money to that from your business, that corporate beneficiary pays tax at 25 cents a dollar, not 47.
But does that need to be as a beneficiary, or it's picked up in that sub-clause that you said?
No, you have to have one.
Okay.
So the sub-clause says you can have one.
The sub-clause says you can have one, but then it needs to be listed as a beneficiary.
Yeah. So it's a very simple thing. So, just get another company, shelf company, put it in there, off you go. And that's the biggest omission I've found with most people with trust.
A couple of months ago.
I've seen where people have had even more than, $3, $4, $5 million income, like a big capital gain from real estate in a trust. No corporate beneficiary. Guess what? That goes to the one of the mum or dad. And imagine getting a tax bill based on $5 million capital gain. Yes. And I saw this guy and said, look, if you had a corporate trustee at the time, that would have probably sliced about, not quite $1 million, but maybe about $800,000 off your tax bill.
Wow.
Just
20%, like 20% or something.
Yeah. It's a no-brainer.
So can that money then just let's talk about, just in that particular example, if you have a corporate beneficiary like a PTY LTD, that profit then is distributed from trust. I'll say David's property trust, P2 LTD. Say I've sold some property, and we'll get into sort of different scenarios and stuff. But once it goes into that P2 LTD, is there a way that I can get it again? Because
there is. So it's gone in. It's had tax paid at 25%.
Correct.
So given the profits in there, and you had 25% tax paid, that sets up a franking credit, which is tax you've already paid, you get to actually use down the track again. So you've already paid the tax, but you get to use it again.
Yeah, but if I pay that then out to myself, the franking credits are taken in for that 25%. But then I still need to pay the 20%, don't I, on top?
Correct. But then my question is, why? why do you want to take the money out?
Okay, you're saying if I don't need to, and if I've got like a 9 to 5, leave it in there and...
Yeah, but even then, why take it out?
Get you.
Okay, so if you're taking it out, you say, well, okay, you want to take it, that's fine. I say, but what do you want to spend the money on? Now, it's your money. I don't mind what you spend it on, but I always query why you're spending it. And there's only two things you spend money on. It's more assets, acquisition, investments, or it's leisure.
Yep.
So what are you taking the money out for? You know, a bit like I was like Scrooge McDuck. I want to fill up the swimming pool and go for a swim in the money. I don't really want to use it. I just want to have it in my bank account.
Yep.
Well, that's dumb because you pay tax on it. So if you're taking the money out to buy leisure assets,
yep,
you know, there's no tax benefits there. But if you leave the money in there and you leave the money in that corporate beneficiary, what do you do with it? You keep investing. You buy some more assets. You lend it to other trusts, and you actually buy more property. So the whole thing is buying more assets, more investments. Because if you've got your personal expenditure set, okay, and you have an indulgence, you need to have a little bit of flexibility there. But if you're making lots of money, well, a lot of the trick is to wealth is actually to hang on to it. Don't waste it on, you know, sort of anything too flashy. Keep it in the company and invest in more assets. Okay, think about capital gains. A funny one. What's the capital gain? You say, is there such a thing as capital gains tax? No, that's the thing as capital gains tax.
Explain.
It's a tax on capital gains. So the capital gain is there, but you pay the tax at the marginal rate on the gain. There's no separate capital gains tax regime. So I say to people, there's only one way you pay tax on your capital gain. And you say, how? You sell it. So if you don't sell it, you're not paying tax. Yeah, how good is that?
True.
So I've got a property, it's gone up a lot in value. If I sell it, I'm going to pay tax on it, or don't sell it. Use it and leverage and buy another one. Now, that doesn't happen in all the cases. There's still a good time to sell property. But people don't think enough about how to manage their cash flow. They get very excited. They've had a really, really big gain in their property.
Yep.
They want to sell it. They want to take the money out. They want to pay tax and then go and party. Terrific. But all things in moderation. So if you want to actually build up a good wealth portfolio, and if you talked before about people having very large wealth portfolios, property portfolios, that's how they do it. They limit what they spend. They're very careful how they spend it. They have the right structures and off they go. So without getting to, I probably want to talk more about trusts. Yeah?
No, this is good too, because this is what the people out there that own a couple of properties, that's the end goal, is to obviously buy, to sell a couple. Maybe you pay down some debt in some other properties. Maybe you cash it out and you use that. Maybe you need a chunk of money you want to use to buy your forever home, or maybe you want to use it to go on a holiday. So I think just tracking the cash and where that goes and how that sort of flows through is crucially important. So that definitely 100% can be part of the conversation. I think one thing I have to add on CGT, it works out to be like 25% anyway. So if you own it for long, correct me if I'm wrong, but if you own it for over a year, you're getting the 12 months, you're getting the exemption, the 12 months exemption on half of it. So half of it you're keeping absolutely tax-free on the profit. The other half, there's a good chance once you add that onto your income, it pushes you to the tax bracket, to the top tax bracket. Okay, you pay 50% on that, but if you look at the $1 million that you just made, 500 grand you're keeping and you're not paying tax on. The other 500 grand, you're paying 50% tax on it. You've paid 250 grand out of $1 million, right?
It's fantastic, isn't it?
Yeah. People make out as if it's like this some huge tax. I'm like, it's less. It's less than your tax rate, your income tax rate, and it's the cost of doing business. If you've got to pay it, you've got to pay it. But let's wind back a little bit. Talk to me a little bit about why you wouldn't buy property, or why or when you would buy property in a trust. When does it come up for your clients, or when are you talking to people and you're convincing them that the trust is not a good idea? What type of property? What type of
Well, it's not a good idea. I explore or interrogate the rationale behind buying it. So the trust might be the vehicle. There's a bit to talk about before we get there.
Yep.
So I say to somebody, you're going to buy a property. Let's talk about the mechanics, what you're going to do. What's the property for? And you say, it's just purely investment. I've gone and talked to a really good buyer's agent. I've decided to buy a property. It's in Adelaide or Queensland or whatever. Happy to do that. And that's your first one. You already got your house or whatever. Or maybe you're just a rent investor. And that's nothing wrong with that. I like rent investors. They're great.
Yep.
So you go and buy a property. It's somewhere in Brisbane. Fine. All geared up in your own name. Perfect. No dramas at all. Okay. Then you say, well, I buy number 2 and number 3. And, again, is it a problem to have 2, 3, 4, 5 properties in your name or in your wife's name? No. So at that point in time, do you need a trust yet? Probably not. Why would you? What's the reason you put it in a trust for? And if it's a longer term build up of assets, No real need. The main reason it pops up is the reason maybe having a trust is the thing called the land tax.
Mm-hmm.
So in New South Wales, if you buy some properties in your name, there's a threshold. $1 million, don't quote me, but I think it's something near there. So and you get your principal residence as a exemption, etc. But if you buy a piece of real estate in New South Wales in a trust, there's no threshold. So you're paying land tax from $1, and that could be thousands of dollars a year. Mm-hmm. Crazy. So there's the reason why not to buy a trust. Because if you're buying property in a trust in New South Wales and you're happy to pay the land tax,
yep,
good. But people say, what's land tax? A number of people I've got on from other previous accountants say, what's land tax? I said, you've got 18 properties. You never paid land tax. No, what is that? You go, good grief. You've got to go back and actually say you've got an issue. And just while I'm on land tax for a moment, I can talk for hours on land tax.
Yeah.
On land tax, just say you've got a property and you haven't paid land tax on it. Just say land tax is liable on it. Mm-hmm. Okay, you've got 5 properties. Okay? The land tax attracts to the piece of real estate. So if you sell the property to somebody else, and normally lawyers pick this up, most lawyers are pretty good, but if the guy buying the property off you doesn't check that the land tax is up to date, and the land tax office picks it up, he doesn't sue you, the vendor, he sues the purchaser, because it attaches to the land. And usually the purchaser's got no recourse back to the vendor, so he goes after the lawyer. I've seen a few of those.
Wow.
Now, most lawyers check it, most conveyancers check it really well.
Yeah.
But I've seen instances where it's just missed, it's not in the contract, and,
So you're saying if that person I'm buying a property off hasn't paid the land tax, because then I buy the property and own it, I have to then pay their...
Yeah, it's attached to the land.
Wow.
So there's all these other things you've got to... So we look at all these things, okay? So there's... That's an interesting one. So, again, you say, well, if you're looking at the property, just buying those small investments interstate, own name's fine for a period of time, okay? Mm-hmm. No big dramas. And those investments might be residential, they might be small commercials, which I like as well. You say, well, what time do I really need to buy property in a trust? Well, what are you going to do with it? Because the trust is presupposes you're going to make a profit. So it's more of a short-term scenario. Mm-hmm. And you say, well, if I'm going to make a profit, how am I going to make that profit? Okay. It might be that I'm going to buy the property, I'm going to do it up and sell it. Okay. And so you make a profit in the short term. Cool. Yeah. Okay. And that profit then flows to beneficiaries. Who are they? Well, husband, wife, and possibly a beneficiary company or another trust perhaps. Okay. So there's a reason why you might have a trust, because you're doing the short-term development and you want to pull some cash out and do some other things. Mm-hmm. And it might be also a structuring thing, because I talked to people about structuring their finances and a whole new topic about getting the cash in to actually knock off their non-deductible home loan and then use the home to actually borrow against to buy some more real estate and leverage it up that way. So there's a few tricks around that as well. But so the trust doesn't really enter the building until there's a whole lot of things happening, and more so there if you're going to be doing more development work. And even then, if you're going to do a property development, I'm saying, why don't you just stick it in a company? Mm-hmm. You say, well, I'm doing a property development, so you're not getting that 12-month sort of taxing. It's not a capital gain. You're paying tax at 25%. So again, the purpose of what you're buying the property for dictates the structure. And I see people buying trust mainly because they want to keep everything quarantined. So it's a set and forget. They want to leave it in a trust. If the property's in a different state, then the land tax can be a whole lot different. Sometimes they say, look, I've got to pay a couple of bucks in land tax, I don't care. Mm-hmm. So it's very important to keep it quarantined. But whilst I really like trust, discretionary trust, I can't see a whole bunch of compelling reasons just to have one straight away.
Look, I think one of the main reasons that I hear people wanting to do it is because this issue with borrowing capacity. So you only have a certain amount of borrowing capacity, which is based off your income. Yep. Now, if you use all that up if you use and buy in your personal name, you might get to 3-4 properties if you're lucky. The bank, then go back to the bank and say, I don't have. The bank will say, you don't have any more income available that you're not using across these other properties to buy another house. People are ambitious and want to then go on and buy multiple properties. They think, how can they do that? And then there's obviously this information that comes across that says, well, if you buy in a trust, there are banks that will, if you buy a property in a trust, there are banks that when they do their credit checking and that kind of stuff, it sort of prolongs your borrowing capacity. In terms, you set it up, you pay a big enough deposit so that trust or the company inside that trust, it's self-sufficient. It works from it covers itself. The expenses covers itself. It's sort of like a trading company or a business. You get a letter from your accountant to say, yep, that works. That's all good. You take that to the bank. You show the bank. They go, yep, perfect. That PTY Ltd, we'll exclude it and we'll go back on just what, for example, David Hamilton has in his name and what he can service. That's where I see people use it. What's your sort of thoughts on that kind of strategy?
Yeah, interesting. That's fairly true. That actually does work. But isn't it weird that it does?
Yeah.
Because it's still you. So it's David Hamilton, the investor. You've got 2 or 3 properties. The bank, that's your problem. The bank has said, you reached your capacity. But then you go and say, well, if I set up a trust, then my capacity increased. Still me. I've still taken some money out of my pool of funds to use as a deposit. Then you go and do it 2 or 3 times. So the bank's really saying, we're not going to limit it to you because you've reached this magical or mystical or capacity. But if you've got 2 or 3 trusts, it's okay. How dumb is that?
Yeah, I mean, that's where...
But I'm saying it's practical. It's a solution. I love solutions, but it's practical. It's dumb.
Yeah.
I think the solution is there sometimes, and respectfully, you've got to have a good finance broker. Okay, so banks are pretty hopeless. Okay, let's say directly to the banks. You walk in, if the bloke's wearing a cardigan and earring, you're in the wrong joint, right? So you got a good broker, and there's lots of good brokers there. Like there's lots of good real estate agents, lots of good buyers agents, good brokers. So a good broker cuts through that BS and says, well, David, like you're just dealing with the wrong bank, mate, and your capacity would go up. Now, having said that, what gives a bit more credence to what you're saying there, and I see this happen a lot, and you're quite right, is that what really killed the banks in a way is that Royal Commission a few years back. The Royal Commission, without won't go into detail because everybody will fall asleep, but the Royal Commission into banking, and what they found that the banks were engaging in practices they didn't like, nothing particularly bad. But the banks just freaked out, and they freaked out by pretty much selling off all their financial planning and insurance businesses. And then secondly, they said, our credit things have to be tight. And so right now, if you go for a loan personally, your credit checking is, pages and pages and pages. They even take into account your credit cards. If you go and get a loan, but in another structure, like a company or a trust, then the credit application is very low. And that's why people are buying things in trusts or companies, not because it's a good tax vehicle, it's because they're getting a loan. And I respect that's fine. So if somebody came along and said, look, I've reached my capacity, and if I buy something in a trust or a company, the bank will give me the money, I'll say, cool, go for it. Now, they're not asking me a tax question, they're asking me a borrowing question. So good brokers know that. Good brokers can probably say, well, no, you've got room for a few more in there. At the end of a long day, the reason why people are being pushed into or encouraged to go into trust because they do want to borrow the money and they do want to buy that property, good call, is because the lending system is cactus. Their broker or their bank is really not playing ball. It's a really dumb idea. The other thing which actually is a positive thing, what you're saying too, is where when they look at that new property purchase in a trust, they generally, if you've got a good broker, don't take into account that you've got obligations personally for another 3 or 4 properties. So you can quarantine off the thing. So you go into actually your bank and you say, I've got 4 or 5 properties and you want to borrow money for the 4th one. The bank generally wants the whole lot, don't they? Okay. Whereas you say, I've got 3 or 4 in my own name and you buy your 4th one or your 5th one in a company structure or a trust structure. Quite often you get that through without actually, you might have a personal guarantee or a letter from accountants. Cool. But they won't take into account your other property. So if you're looking at benefits, why a trust is there, it's a borrowing benefit, it's a quarantining off of your assets benefit, flexibility benefit. No, there's not a lot of tax benefit there, but that's still worthwhile. And I mean, if I'm a property investor and I'm buying in trusts with that knowledge, 100% behind it for sure. Unless you know that, I don't like people to go and buy a trust for the sake of having one and not knowing what the breakup is and how it all works.
Yeah, well, I think also one thing I'll preface is that you need to. When buying in that trust, normally it's not something you do your first investment purchase because you need that 20% deposit and stuff straight up front. So that's obviously a lot of money for $400,000-$500,000 house, and it's quicker for people to buy a couple in their first name then move into it. Chris, I want to shoot to you a couple of scenarios of some people that might be listening, and give me your ideas, give me your thoughts on sort of structure, or is a trust something that they should explore? Okay,
cool.
So the first thing is a couple want to go and buy their forever home, and they're thinking of buying it in a trust because that's what they've heard online, and they think that's a good and safe way to set it up. Would that potentially be something that you would recommend?
No.
Why is that?
Well, because if it's a forever home, their residence,
Yep.
they don't get the exemption from capital gains tax as your principal place of residence.
Because it's in a trust.
It's in a trust. And even though they say, well, the trust is me and my wife and kids and we're living in the house and we're residentially using it, being in a trust, it knocks out the principal place of residence, got to pay capital gains.
Okay.
And then, secondly, they expose New South Wales to land tax.
Okay, so pretty much if it's your PPR, stay clear of trusts.
Correct.
Okay. What about if it is if I'm buying a property, let's say with my brother?
Yeah.
Me and my brother, we want to buy a property. It's an investment. How would we structure that, do you think is best? Personal names, trusts, how would we sort of set that up?
Again, depending on what it is, I mean, it's an investment, so you're just going to buy it. It's a set and forget.
Buy long-term hold.
Yeah, I'd say, look, why not just have a partnership?
Okay, what's the partnership?
Just the two of you sign an agreement saying we're both 50-50 owners or 60-40, whatever the case may be.
Yep.
And the partnership agreement, you'd have one even though you're brothers, would be to say what happens if something goes wrong. So if you say to your brother in 5 years' time, look, by the way, I've found somebody I want to get married to and I need to sell my half of the property to buy the dream home. What's the mechanism? So partnerships are fine as long as you have a agreement. So anything you do with somebody else, whether it's a brother or a mate, have an agreement because it just stops the fights. Okay?
If it's not your
spouse,
significant other.
Yeah, I mean, then like you're in a whole world of different hurt there. No, I'm kidding. But if it's a significant other, look, I mean, there's obviously some trust there and et cetera. But so, buying things, you and your wife or buying a forever home or buying investment properties, that's pretty cool. You talk about trust there. But if it's, like your brother, have a simple partnership. Why go any different? If you bought it in a trust, what type of trust? And then you've got this family trust.
Would you do family or maybe a unit trust 50-50 or anything like that? Yeah,
I'm just looking at the costs and the benefits. Accountant will set you up in a trust or a unit trust and send you a bill, and each year's you got to pay extra accounting fees. If you don't need it, I call that the sort of ashtray on a motorbike strategy. As opposed to the porthole in the submarine.
Tell me, what do we look in startup costs and running costs if someone's considering it? We'll go back to a few of the other strategies, but because you touched on it, what are we talking about? What's a range of trust? And it's probably going to vary between accountant to accountant. Obviously, preface this with saying buy peanuts, get monkeys, this kind of thing. It's not the cheapest person you want to work with, but do you have sort of ballpark figures with setting up trust and running costs too, BASs and all that kind of stuff? Yeah,
look, I think if the trust is just purely set up to buy real estate, and there's nothing wrong with that. And look, just before I answer the question, look at the scenario whereby you want to go out and you buy a few properties and you want to do them up and sell them and make some money. You still do that in a trust, but then you have a corporate beneficiary to make sure you're not paying any more tax than 25%. Okay, but I think that the setting up costs is that what we look for and most accounts look for is relationships. We want to have longer term clients. It's not come in, buy something, see you later. It's not the 7-Eleven of accountants. So you say, want a relationship. So you're hoping that over time the client will get you to do their accounting work and whatever, and maybe refer some business. So normally the cost to set up a trust is allow about $2,000. Okay. That includes the disbursements. So that's the actual cost of incorporation. It's the cost of the trust deed. That's about it. Unit trust, again, it's a scenario, depending on how many partners and how many things you want to do, that could be 4, 5, 6, up to $10,000 or maybe even more, because you might have 3 partners and that might be one unit trust with a corporate trustee. You might have all the units owned by their family trusts. Okay. Common structure. So then you've got another company for each. Yep. And family trust, and then down the track another 3 companies as corporate beneficiaries. That gets pretty expensive.
What about setting up just that PTY LTD to act as either the trustee or as the beneficiary? Is there much setup cost and time and effort in that?
No, not really. I think if you're just having a straight company, and the company's just to run your business, it's normally set up. I just allow about $1,500 for that normally. But if people are saying, well, I want to do a trust with the corporate trustee at the same time, a couple of grand. I mean, it's sort of like it's not hard to add to the trust. I mean, if the trust is by itself, I wouldn't do it.
Yeah, okay.
But if somebody says I want to trust and it's a good reason, I'd say unless you've got a corporate beneficiary,
wouldn't do it.
Wouldn't do it.
And what about operational costs? How often? What are the obligations?
Well, again, with having a corporate trustee, there's an annual fee to ASIC each year, a couple $100. The accounting work, well, I mean, if you bought a property and you bought it through, just say a really quality, say, buyer's agent or something like that, and the property's got, it's managed by an agent. So each year you're getting a full rental printout.
Yep.
You've got it comes hopefully with a quantity surveyor's report to get all the depreciation deductions, and that's all handed in on a plate. That's probably $800-900 a year. Got a few moving parts, or you're a crappy bookkeeper and your stuff's in a mess and you bring it in a shoebox.
Yeah.
The cost goes up. But most things like that would be, for a property, probably allow $1,000 for that.
Okay, and that's only yearly? That's not quarterly or anything like that? It needs to be nothing.
You wouldn't need a BAS unless the property's operating, like it's commercial property. You don't need GST. When we set up companies for people in trust, we do all the registrations. That's an ABN number, a tax file number, bank account kit, everything. So it's ready to go. You pay the one fee. But we also include, that's a bit of a chat and a discussion, so we show you how to drive it, move forward with that. So it's a pretty simplistic cost. If you go ahead and set up a trust with a corporate trustee, normally, it's ready within a day.
Wow.
We normally come back and say to people, look, you've got your company and your trustee. Guess what? The company's been formed straight away. We actually usually send you an email saying, there's the company's birth certificate saying, no, it's been done.
Wow.
And that name you've always wanted, that really cool, groovy name, you've got it. So we search too, you have all these names and, we go through them. There's some really weird ones there. But if the name looks available, then we say, yes, it's probably worthwhile. We always ask you to give 1, 2, 3 alternatives.
I've seen a couple of funny trust names.
But it's pretty fun.
Okay, set up, operation costs, I'm understood. If I'm buying with my significant other, you're saying that it makes probably most sense from a cost perspective to be buying that in your own name, so you can leverage things like capital gains, tax exemptions if we're buying. If I'm buying with a friend or another member of family that is not my significant other, you're saying partnerships is probably a good thing to look at and go into.
Yeah, at least consider it.
At least consider it. And then talk to me about, all right, property investors. That's a lot of our audience. How should a property investor, we'll say, for example, they've got 3 properties under their belt. They know they've got enough borrowing capacity to buy their 4th, but that's going to be their end limit in terms of their borrowing capacity. So they said, look, instead of buying that 4th, I want to set up a trust. I want to buy the property in that trust. That's my real estate goals. That's going to be a long-term hold down the track in my property investment journey. Maybe after 10 or 15 years, I'm going to sell a couple of these. I haven't really made my mind up just yet. I'm going to sell a couple of them down. I'll use the sale proceeds to then pay off the mortgages of the other ones. Then I'm going to live off 4 or 5 properties that have their mortgages fully paid off, and I'm going to live off the rent. What sort of setup do you think that is going to look like for that sort of property investor, given that that's the long-term goals?
Yeah, that's pretty much it. I mean, it's a fairly normal scenario, and that 4th or 5th or 6th property in a trust is fine. First thing I say is, where is the property?
Okay,
because in New South Wales, I say that's no problem at all. Okay, but you're going to be paying land tax, and they go, how much? That's fine. If it's in Queensland, there's thresholds. All the other states have various thresholds. So, I always think if you can save a couple of dollars, may as well do that. If an investor's taken into account they have 3 or 4 on their name, and then buy another 2 or 3 or 4 interstate or whatever in a trust name, that's perfectly fine. So there's nothing wrong with that. It's just pointing out the fact that, they don't want to get a surprise a few years later when nobody told them about land tax.
Okay. And if I'm buying that property as an investor under a trust, we set that up. That's going to be a discretionary trust.
Yep.
Beneficiaries, would that just be the property investor, or you are recommending as well to have a PTY Ltd as a beneficiary too?
Not straight away.
Yep.
Not straight away. So you go into that scenario, and let's just say you as a single person or you as a couple. They're your primary beneficiaries, because it says in that particular trust that it takes into account future beneficiaries. So it takes into account for your future spouse or future children. And you say, well, I don't need that corporate benefit yet because it's a set and forget. This thing's going to be, 1 or 2 or 3 in that trust, and I'm not going to sell them for many years. When you get to a stage when you're thinking about selling it, then you go to the accountant and you say, well, what's my tax outcomes? And he might say, well, there's a tax outcome which is quite large because you've made a lot of money. So then they might say, let's stick in a corporate beneficiary then. So you can delay that.
Oh, perfect. So you don't have to... If someone's listening to this and they've forgot it, they can add it after.
Yeah, absolutely. Yeah.
Oh, okay, thank God. Perfect.
Depends on the trustee.
Everyone breathing a sigh of relief, including me.
No, you don't have to. Yeah. I mean, if somebody's day one said, I want to set up a trust with a corporate trustee, and I'm going to do something very quickly, and I need a corporate beneficiary because my personal income is really high, the cost of adding that extra company, it's probably going to add another $1,000 to it. So that $2,000 becomes, say, $3,000.
Yep. We'll get into development after, but that would be the best. That would be the best scenario. Do you think? And it might be a question for you. It might be a question for a broker. But is it? Am I say I've got the 3 properties for number 4? I want to go and buy another 2. I'm buying in Queensland, for example. Should I buy those 2 in Queensland under separate trusts, set up a new trust per property, or should I set up a new trust and buy a couple in there?
Yeah,
3 or 4, and then set up another trust. Because I've got ongoing fees, set up costs and stuff.
Yeah. It depends on purpose.
Yep.
So if you say they're all going to be pretty much the
long-term
same,
holds.
Long-term holds, and second, it depends on your borrowing or your broker. So the broker said, if you want to buy 3 in the one trust, we can finance that.
Yep.
So therefore, if he says no, we can only buy 1 per trust, you need 3 trusts. So it comes down to having a bit of an accountant input there, but also a good broker. So if you can find yourself buying, say, 3 properties, over a period of time in the same trust, therefore we don't need to set up more than one and save money. Perfect. Mm-hmm. It just comes down to that. It's all a similar purpose, and you've got a good broker.
Yep.
That's sort of the other part of the advisory piece. You need a good accountant, a good broker, and probably a good lawyer.
Okay, so it's more a question for your broker. You guys can set it up and get it all up and running, but the broker will probably borrowing capacity and stuff within that trust is going to be.
Yeah, but it's like that pre thing. So you say, look, Mr. Broker, Mr. Gunn, I'm thinking of buying 3 properties in Queensland. Here's the story.
Yep.
Before I go out there and stick my finger up at an auction, hopefully to bid, can I, what's my capacity, my limit? And the broker comes back and says, look, you could actually buy 3 properties, probably your upper limit for the whole 3 is maybe $2 million. Mm-hmm. You get that in writing, go your hardest. And then the broker comes back and says, well, that's, he's the lender, he's the interest rate. So you take all those into account before you go ahead. You don't go in, and most people don't go in and buy without having some type of a pre-approval. Mm-hmm. And that way up front whether, one trust will do for 3 properties or whether you need separate trusts. I've done some work for people and they like buying properties in separate trusts and they don't care about the cost. And I say, why do you want to do that? And they say, we just want the flexibility of having to change their mind.
Yeah, okay.
So
what about if I've stuffed up? What about if I've got 4 properties now and I think, fuck, I've got no borrowing capacity? The 4th property that I recently just purchased has it's positively geared. I can move that into a trust. Is that possible after I've bought it in my personal name to move it into a trust? And what are my implications with costs to do that?
Yes, it's possible, and you get belted for stamp duty again.
Okay, so you've got to pay stamp duty on the entire...
Yeah, the second time. The government loves you.
Okay, no way around that?
No.
Okay, so just pay stamp duty for whatever state it's in, and then you can move it straight into the trust.
Well, no, I'm saying if you bought the property in the name of the trust, fine, but buying it in your name and then transferring it into
the trust. Yeah, that's what I'm saying.
No, stamp duty.
Okay, so I still got to pay it, but I can do it.
Yeah, you can do it.
Okay.
Yeah.
So technically, if I've stuffed up, I can... There is hope for people that they don't need to sell their properties. If they've stuffed up, they've got 4, they've got no borrowing capacity left. What they can do then is, and it's going to be expensive, but depending on the price of the property, right? Because stamp duty, if we're talking $300,000-$400,000 properties, it's not going to be the end of the world. It's a lesson. It's a very expensive lesson to learn. But then I can transfer them into them. I can free up borrowing capacity. Then I can go again and again and again. Yeah,
well, I mean, I had a recent case study on it where a guy bought a property, really nice property, but didn't get the right advice from his lawyer or his accountant. Mm-hmm. Came to me, and I said, well, look, there's a bit of wiggle room here. So I came up with a scenario to get around it, and in the end he didn't quite get around it because he sort of chickened out a bit. But his solution was, well, if I move it out of the trust I bought in, because he did the same thing. We went and bought a trust, bought the property in a trust, didn't get any real advice from an accountant or lawyer. Yeah. And after he bought it, he realised he had a big land tax issue. Because he thought he didn't, but no, you thought you didn't. So his only solution, he was okay with it. Yep. Was to transfer it out of the trust back into his own name, because in his own name he didn't have the same problem. Yeah. And it was like 25, 30 grand, and he said he just bit the bullet and.
Well, it's a one-off fee. Yeah. Why wouldn't he do it? It's a one-off fee. You transfer it back to your personal name. You don't have to pay the land tax every single year for the.
Correct. Yeah. Well, what was his philosophy? I said, well, sure, but I still think that he had, I would have still gone after the exemption, because it was very close to getting the exemption anyway. There was the exemption for land tax, but he got to a stage he just decided that it was easier for him mentally to pay the 30 grand than to actually fight. So anyway,
okay. Well, that's property investors. Now the next type is still going to be the investor, but the person that's doing a bit of development work is the person that's maybe they've got a couple of properties or they've got a really high paying job and they've got some large chunks of capital and they want to throw that round in a couple of different projects, let's say duplexes, townhouses, or properties that they intend to buy, to develop and build somehow, and then to sell off and realise that profit.
Yeah.
What are we looking at? What do you think is sort of some guidance around structure with that particular scenario?
That's good. Well, the first thing is that if they're sort of pretty good high income earners anyway, they don't need more income like a hole in the head. They don't need to be paying the 45 plus 2%, 47. So if they're saying we're going to do some development, townhouses, duplexes, whatever, different structure. Again, if it's a fairly short-term scenario, I like companies. Mm-hmm. Okay, now if there's some reason for a trust, and there might be, we talk about that as well. I don't dismiss them outright. But if you say, look, I've put some money in, I'm developing a property, the other end I'm going to make $1 million profit, well, happy to pay 25 cents on that. Because if it's in a trust, where does the money go from a trust? Who pays the tax? Well, you're going to give it from the trust to whom? Okay. Yourself. I'm already on 47, I don't need that. You're going to put it into a beneficiary company, so you might as well have the company to start with.
I mean, so if you've bought it in a trust, if you've done it in a trust, you can then divert that out to a PTY Ltd. Yes. It's longer waited, obviously, do it, or you can buy it in a company straight away.
Right. Yeah, so you can do both.
Okay.
And look, you might say I want to do it in a trust. Mm-hmm. There might be some reasons for that, but in a trust, you've got to distribute all the money out every year. Mm-hmm. You can't retain it. In a company, you can retain the money.
Okay.
That's another reason. So if you want to keep developing.
Yep.
And look, sometimes I find people, they might have a development site they own in a trust, okay, and then they form a company and the company does the development. Mm-hmm. So the company takes most of the profit. When the property is built, then they might not sell it straight away. They might hang on to it.
Yep.
And there's some tricks around this, but if you hang on to it long enough and then you sell it, you might get some capital gains tax relief, which in a trust might be helpful.
Okay. So let's dig into that a little bit further. If it's purely going to be a buy, build, sell, get rid of company.
Yep.
But if there's a potential, because there's some people, some guys, some of my friends and some of my network is, some people like to retain. So they might do a project that has 700 grand worth of profit. Now, instead of selling all the townhouse job, instead of selling, say, the 5 townhouses, they'll sell 4, they'll pay off all the debt, and then they'll keep the 5th townhouse unencumbered, no mortgage, and retain that asset. And then they might borrow the equity out of that instead of selling it, because if they sell it, you got to pay all those sort of taxes and CGT and stuff. Is it best to have that structure then in your discretionary trust and do it that way if you're going to retain that last sort of that property? Or in a company?
Yeah, no, if you're going to do that, again, here's the cool part, that there's a million scenarios. So,
I'm trying to think through a couple. We're not going to hit them all today.
Good. No, but scenarios are, because that's the whole skill of becoming a good accountant and advisor.
Yep.
You say, give me a scenario, and you do it this way, and there's another scenario, do it that way. So it's all a bit different. But in that case, definitely, I think a trust sounds like a good idea. Mm-hmm. And then you say the profit from the trust, you distribute that to your bucket company or your beneficiary company. Mm-hmm. And then the other one stays in the trust for longer term. Now, there's a big trap in this. Most people miss this one all the time.
Yeah, tell me.
The trap is, so you're doing some development, and I've done this, right? So you're going and developing 5 townhouses, okay? So you go and borrow some money, get the finance right, you engage your builder, everything's cool, sign contracts. Mm-hmm. So you've set that up in your structure, okay, called a trust, and you're developing. So the first thing that comes into your mind is, well, when you're paying all this money out to the builder and when you're paying all this money out to materials and whatever, you want to claim the GST, don't you?
Correct.
And you do. So you want to claim the GST, and you know that when you sell those properties, assuming residential, then you've got to pay GST on the sale. Mm-hmm. Okay, so it's a timing thing, okay? But what if at day one you said, well, I'm going to do this 5 properties, and right at the end of the project you've sold off 4 and you say, I'm going to keep the 5th one. Mm-hmm. Problem, because you've claimed GST on that 5th one.
Yeah.
So you're going to be taxed on that, not as a capital gain, you're going to be taxed as another business investment. Mm-hmm. So the trick is that if you've made up your mind earlier on to keep 1 or 2 out, which is the strategy you described is a great strategy in terms of building some, selling some, retaining some, paying off debt, re-leveraging.
Yep.
Great strategy. Fantastic, right?
Yep.
But day one you go, right, well, we've got 5 properties, we're going to keep 2. So therefore we only claim the pro rata GST on the 3, not on the other 2.
Okay.
And at the end of it, then the other trick is when you've got residential property, you've got to hold it for 5 years. And if you hold it for 5 years, then you can actually get your CGT 50%.
Okay, and that's even if it's not a PPR?
Yes.
Okay. Awesome. Are you able to, just because you triggered me there on GST margin scheme and how that works compared to normal GST just in development space?
It's a bit of a hard one for now because I haven't seen one for ages because they normally go back to how long you've owned the land for.
Okay.
But it's probably it's pretty hard to explain that.
Okay.
Simply, but you don't see them that often. It's only when they've got land that's been owned for a very long time
to do the margin scheme.
Yeah, and there's another trick around that too, is where it's a ruling that I used once that allows you to increase the value of the land by using a margin scheme type technique. So it's a bit technical.
Yeah, okay.
You can use it, but they're the things you look at. So your client comes in and says, "Look, what's the best way we can set this up? Can we use the margin schemes anything at all?"
Mm-hmm.
But it's a bit too hard to answer simply.
Okay, so it need to be sort of specifics of the projects and stuff like that. But good thing to know that if it's a development and you are buying that within a trust and you're holding it on to for say 5 years and then you can sell it GST free. Look, I think that's a really good start, Chris. I'd like to have you back on. I'm just aware of time and we're approaching an hour chat, and I don't want to fry people's brain too much. But I think we've built a really good knowledge base around trusts, a couple of different scenarios where this might work, and what it'll answer a lot of questions for people. And I'm likely, when I put this content out, I'm going to have a lot of people come back to me and ask more questions, and then, we can get you back on to dig deeper into a few of those sort of topics and nuanced questions. But I really appreciate you coming on. I usually ask at the end of every podcast 2 things. One, I ask for, and this whole podcast has been it, but I ask for a golden nugget. So one piece of information shared with the audience that's high or significant value. I usually say if you've never done it on a podcast, and I think this might be one of your first ones, so something that you've never shared before, but do you have sort of like a golden nugget you can share with anyone?
I think I've got 2 nuggets.
Yeah, tell me. Tell me.
Okay, well, the first one is that, and a lot of people don't know this, is that when you form a discretionary trust, you've got to pay stamp duty on the trust. So there's a stamp duty charge, government, New South Wales I'm talking about now.
Yep.
And that's just gone up to $750.
Yep.
Right. So what we do when we form a discretionary trust, and there's a way we do it, we form them in Queensland. Guess what the stamp duty is?
Nothing.
So you save $750.
Okay. Does it matter about the state of origin that you're?
No. Now, the second part about that is that, and this is the second nugget which is related to it, is that I look at trusts and I've got this weird thing. I don't say I like it, but I'm actually good at reading documents. So when a new client comes on, I say, "You got a trust, mate? Give me a read of it."
Yeah. And
I know what's in there. I know where the bodies are buried in the trust. And any trusts that have been formed probably before, 2020, 16, a lot of legislation went through federal and state, 16 up to 20, where it said there's a foreign investors scenario. Mm-hmm. So they were trying to actually charge extra for foreign investors like in stamp duty, so if you're a foreign investor, and also in land tax, and they put that through trusts. So if you're buying a property in a trust and you're a foreign purchaser, you paid a lot of extra stamp duty and a lot of extra land tax holding it. Now, the point being is that to get around that in a way, or to actually do that, that the modern trusts have clauses there that say that the trust prevents foreigners being beneficiaries.
Okay.
And you go, well, that's okay. I'm an Aussie and I've got kids. I'm not gonna, I've got no Uncle George in Canada,
Yeah.
No, the problem is that what if you have a trust and it's you, your wife, and you've got 3 kids, and one of the kids then decides to move to Canada? Foreign beneficiary. So have they got the capacity to be a foreign beneficiary? Absolutely.
Wow.
So you've got to have a clause in the trust that says you can't have any foreign beneficiary.
Yeah.
And then secondly, it's got to be in New South Wales, particularly irrevocable. So you can't change your mind. So there are people out there that have got trusts that have been around for a long time. And if those trusts have been around for 2, 3, 4, 5, 10, not 2 years, 5, 10, 20 years, probably fine if they've never bought real estate.
Yeah.
They've bought real estate in them. They're being hit with a big land tax bill, and some of them don't know it. One client was just paying this big land tax bill every year, and he said, "I don't know why I'm paying it." I said, "Well, it's because your trust deed's so old, you're getting hit with this thing. You didn't update your trust deed." So he fixed it. Okay, so for, I think $600-700 we fixed it. Now he doesn't have to pay land tax again. Wow. It's great. So trust deeds that are pretty much been, and these are quality ones that people have got from lawyers or formation services or accountants, if they haven't been updated, and people want to buy property in them, you're going to be paying a lot of extra tax. So first thing I look at is if you've had a trust deed for a few years, is this clause in it? I know where to look, and if it's in there, happy days. If it's not, you've either got get a new trust deed, modern one, and we specify in our trust deeds that we get that those clauses are in there, which cover all states and specifically out a clause for New South Wales.
Can you can you redo the deed of a trust that's already been set up?
You can amend it.
Oh, you can amend it. Okay, perfect.
You can amend it.
Awesome.
So if you want to keep the same trust,
Mm-hmm.
because you want to buy some more property in there, just have it amended. But if you've got property in a trust and it's an old trust deed, you'd be either A, paying land tax when you shouldn't be, and if you don't know you've got a land tax problem, you've got a very latent hidden problem. When you go to sell those properties, you're going to get a bit of a tap on the shoulder and say, here's Fred from the state government, where's my cheque?
Wow.
So we always make sure that when we're forming trusts for people, we look at the way we do it in Queensland, and we also make sure that old trusts are read thoroughly. I've found so many mistakes in trust deeds, I've got to tell you.
Yeah.
Unsigned, undated,
Yeah.
wrong beneficiaries. Terrific. So, in documents, I find a lot of them are actually just incorrect and they're fixable.
Mm-hmm.
But if you don't read them first and a big deal comes up,
Yep.
you get clobbered.
It goes without saying is that you need to get that professional advice and pay for it early on.
Well, you just look at just review it,
Yeah, but the layman like me or Travel, someone's probably not going to pick up a lot of these sort of clauses where, chuck it to you, give it a review. Like if you're a couple $100 or $1,000, if they're charging that to review it, if it's saving me paying tens of thousands of dollars in land tax a year, you'd be crazy not to.
Well, and that's the point. I mean, and land tax is something where, a lot of people just don't know they've incurred it because there's no system. Like we've got this system whereby you think the land tax is all online.
Mm-hmm.
Most of those registers are also linked with the ATO. And you think, every year I bought a property, shouldn't they send me a bill? No, you actually got to register. And if you don't register, very rarely does it ever show up in dispatches. And then 5 years in, you've owned a property. And then you go to sell it and your lawyer says, where's your land tax clearance? They do a clearance, you've never registered for land tax, and you get a bill for 20, 30, 40 grand.
How do you, just quickly, how do you know that you're over that threshold? If you say you own 4 or 5 properties in New South Wales, how do you know if you're over that threshold or not?
Well, what you do is each of your properties has got a thing called an unimproved capital value, UCV, which is set by the Valuer General.
Mm-hmm.
Normally sometimes it's on your rates, depends where the property is, or you get a little blue slip that has it on there.
Yep.
Or you can look it up. You go in and put all your title particulars in the state government website, tells you what it is, and it tells you what the UCV is, the unimproved capital value, not what it's worth, not what you paid for it.
Yep.
And then it tells you what the threshold is. So you add them all up and you go, there's my threshold, I'm under, happy days.
Sneaky little one. I reckon everyone should check
Very
if they
sneaky.
own multiple properties, thinking that if I didn't get the bill, I don't know it, but it's one that you can get pinged for down the track.
Yeah, and one other thing, I know we're running out of time, but just be very careful that a lot of people, when they go out and they're developing property, so they go and buy a property, even live in it, right?
Mm-hmm.
Hang on to it for 12 months and then they sell it and they think, capital gains. You do that once, maybe do it twice, keep doing it. It's a habitual pattern. The tax force picks those up. So the old flippers, be careful. And that's another reason to possibly, if you're a flipper, have it in a different structure. Mm-hmm. If you do it in your own name, it often pollutes your principal place of residence. So,
okay. Raises a few red flags.
Yeah, so just be mindful as well. But I tell people all these stories so they don't stub their toes.
Man, I really appreciate it. Chris, thank you so much for coming on. My last question is, what is a quote that you live your life by?
Watch your thoughts, they become your words.
Mm-hmm.
Watch your words, they become your actions. Watch your actions, they become habits. Watch your habits, they become character. Watch your character because it becomes your destiny.
Quality. We'll end on that note. Chris, I appreciate you coming on the Everything Property Podcast, and I'm sure we'll get you back on shortly to talk all things accounting. Appreciate your time.
Happy days. Good stuff.
Thanks, mate.
Okay.